Every time you swipe your debit card or deposit your paycheck, you are making an act of trust. You hand over your hard-earned money, it vanishes into a screen, and you trust that it will be there exactly when you need it. The network processing that money is designed to do three specific things: keep your funds safe, move them quickly when you want to buy something, and pool that money together to offer loans to people who need them. The biggest players handling these tasks are commercial banks. These are massive for-profit businesses that manage the bulk of our everyday deposits and hand out the majority of consumer loans. Alongside them are credit unions. These serve the exact same functions, but they operate as smaller, nonprofit cooperatives owned by the people who use them, often focusing on specific local communities. Overseeing all of this activity is the central bank. Think of it as the ultimate referee. It creates the rules the other banks have to follow and monitors the overall health of the country's entire currency. Most of us imagine our money sitting in a quiet, dusty vault until we need it. In reality, that money immediately goes back to work. It is pushed out into the world to fund new projects, and the moment it leaves the building, it is in danger. Banks make their profit by taking the cash sitting in your checking account and lending it out to someone else, charging them a fee, called interest, for the privilege. This creates a constant balancing act. On one side of the scale is the opportunity to make a profit by lending out deposits. On the other side is the very real possibility that the borrower might lose their job or their business might fail, and they cannot pay the loan back. If a bank becomes overly eager and makes too many risky loans, the scale violently tips. The money is gone. And since that money actually belonged to the depositors, the bank fails. The people running these institutions cannot see the future. They have no absolute way of knowing which borrower will succeed and which one will fail. So to survive, they have to take the messy, unpredictable nature of human behavior and turn it into precise, manageable mathematics. To see how they do this, we have to look back to the 1700s and a mathematician named Daniel Bernoulli. Before Bernoulli, financial risk was treated a lot like rolling dice. He was the first to analyze risk not as blind luck, but as a mathematical equation. He proved the math behind a very old piece of advice: do not put all your eggs in one basket. Instead of making one massive loan, a lender spreads their money across hundreds of smaller, separate loans, a concept called diversification. If one borrower defaults, the loss is contained. The other successful loans cover the missing money, keeping the system steady. Bernoulli provided the banking world with a theory for survival. However, as the global economy accelerated in the 20th century, general theories weren't enough to prevent crashes. Banks required a precise, repeatable formula to stay solvent. That formula arrived in 1952, thanks to an economist named Harry Markowitz. He wanted to take Bernoulli's idea of spreading out risk and turn it into an exact science. Markowitz developed something called modern portfolio theory. Instead of just making a lot of different loans, his theory provides a strict mathematical blueprint for exactly which types of loans a bank should make at the same time. Notice two volatile lines moving in opposition. Pairing investments that react differently to the same event makes their reactions cancel out, forming a smooth upward path. This equation calculates a hard floor, predicting the absolute maximum a bank might lose in a worst-case scenario. Armed with this math, banks no longer had to cross their fingers and hope borrowers would pay them back. They could engineer a portfolio of loans so stable that individual failures simply did not matter. This complex math is happening right now at the local branch down the street. When you drop your savings into a commercial bank or a credit union, Markowitz's equations go to work protecting it. Because the bank can mathematically limit its risk, it can confidently lend your paycheck out to help a family buy a home or allow a neighborhood bakery to buy a second oven without putting your deposit in jeopardy. And at the highest level, the central bank uses these exact same principles to monitor the entire country, balancing interest rates to ensure the national economy stays upright. That secured flow of cash, moving safely from those who save to those who borrow, is the literal mechanism of economic growth. The number you see when you check your balance on your phone is part of a dynamic, risk-managed engine that has been centuries in the making. Your deposit represents the health of a system that is constantly moving, balancing, and building the world around you.